Okay, well, in the interest of everyone's time, I guess we will get started. So hello, everyone, and welcome to our first Edmonton CREW education event of 2022. Thank you so much for taking time out of your day to join us for our panel discussion on the various forms of legal structures for commercial real estate ownership. My name is Jane Wortman, and I am the chair of the Edmonton CREW Education Committee. First and foremost, before our event begins, Edmonton CREW acknowledges that we are located on Treaty 6 territory as well as the Métis Nation of Alberta's Region 4, a place that has been home to Indigenous peoples since time immemorial. Indigenous peoples are the original caretakers of this land, and as such, they are also the original stewards and developers of our real estate community. We express gratitude and respect for those who came before us as we as an organization look to advance the careers, achievements, and successes of women in the commercial real estate industry. As we take part in the design, building, and occupancy of physical structures and land, we also continue our work towards building solid foundations with Indigenous communities. Before I turn the discussion over to our terrific panel, I would like to take this opportunity to recognize the sponsors of today's event. At the Diamond level, we have One Properties. At the Platinum level, we have Cushman & Wakefield, GWL Realty Advisors, Institutional Property Advisors, Manulife Investment Management, RBC, TD Bank Group, the RMS Group, and Witten LLP. Thank you for your continued and generous support of Edmonton CREW. Some quick housekeeping items before we begin. Edmonton CREW is pleased to be able to offer this programming to our members free of charge. We ask that you might consider donating to the CREW Foundation, which is the philanthropic arm of CREW Network through scholarships, industry research, and career outreach. There's a QR code up on the screen that will take you directly to the donation portal. Please place your microphone on mute for the duration of our event. Should you wish to ask any questions, please type them into the chat function and our moderator will monitor. We'll have time to ask questions or to address these questions on each segment at the very end of the discussion. Please also remain online until the end of the event as we have a door prize to give away. Now let's get started. Our moderator for today's discussion is Cathy Farnell. Cathy is a commercial solicitor whose practice emphasizes commercial real estate and property development, business law and financing, including real estate construction and term financing, corporate financing, and equipment financing. Cathy has been recognized in the peer-reviewed list, the best lawyers in Canada in the areas of real estate law, project finance law, banking and finance law, and commercial leasing. Cathy has been the managing partner of Witten LLP since January 2021. And with that, I will give the floor to Cathy to start our discussion.
Thank you, Jane. I'm pleased to have the opportunity to introduce our panel for today's discussion. Patty Walsh is a partner in Grant Thornton's Audit and Business Advisory Group, and she leads the construction and real estate team in Northern Alberta. Patty is the practice support director for Grant Thornton's Western Canadian offices and has her focus on financial reporting, audit methodology, and advisory services in all aspects of real estate development, construction, and operations, and for public and private corporations. Patty was an inaugural recipient of the Grant Thornton Professional Excellence Award. She has been an active member of the Canadian Institute of Chartered Accountants and a guest lecturer at the University of Alberta and NAIT. Patty served as the 2017 president of Edmonton CREW. Jessica Fabro is a partner with Denton's Tax Group. Jessica advises clients with respect to tax matters, and in particular provides tax planning, business succession planning, and estate planning advice, focusing on private corporations, high net worth individuals and family offices, including the implementation needed to meet clients' objectives. Jessica also advises clients on tax-effective structures for their businesses and succession planning needs, including corporate, partnership, and trust structures. She has experience in tax dispute resolutions, including negotiations with both provincial and federal revenue agencies, and at the British Columbia Supreme Court, Alberta Court of Queen's Bench, Tax Court of Canada, Federal Court of Appeal, and Supreme Court of Canada levels. Kara Engley is a chartered professional accountant and is the financial controller for Camgill Development Corporation. Kara oversees the financial reporting on Camgill's portfolio of joint ventures, limited partnerships, and corporations. She thoroughly enjoys complex transactions, reconciliations, and data analysis, and is passionate about providing clarity and meaning to financial information. Real estate accounting has provided her with endless opportunities to examine and prepare a wide variety of capital and operating budgets, financial statements, and various analyses. She has had the privilege of being with Camgill through an enormous period of growth and change, and believes that adaptability, a continuous love of learning, and the support of great people have contributed to her success in this industry. Today, Jessica, Patty, and Kara are going to walk us through various structures for holding real estate, and they will discuss some of the pros and cons of each structure and some situations where each structure may be best used. To start us off, I'm going to turn it over to Jessica to start the discussion, beginning with using corporations to hold real estate.
Thanks so much, Cathy. Good afternoon, everyone. As mentioned, I'm Jessica Fabro, a partner with Dentons in Edmonton. While my background is in tax, I have worked with a number of real estate developers and landlords, both in British Columbia and Alberta, in structuring their development or real estate rental projects. Today, I'm going to be discussing some of the most common structures with respect to real estate development and leasing projects. So as Cathy mentioned, the first one will be that we'll be starting with is the corporation. And this is an entity that I think almost everyone is familiar with, but just a bit of background. A corporation is an entity that is its own legal entity, so it's a separate person from that of its shareholders and directors. It has an indefinite lifespan, so the corporation will exist until it is dissolved, either because the shareholders have decided to, or it's dissolved by operation of law, for example, not filing its annual returns. And typically it has a limited liability, assuming that the corporation is not a ULC. And a ULC is a special type of corporation that's an unlimited liability company. And this is typically only used where foreign taxes are a consideration. So you won't typically see it within a wholly Canadian structure because it results in unlimited liability for the shareholders. So a corporation is created under the applicable corporate legislation. And so in Alberta, this is the Alberta Business Corporations Act. There is no requirement that a corporation be incorporated in the jurisdiction in which it is doing business. So the incorporators can choose the jurisdiction that best fits their needs. And corporate legislation does vary, from province to province and into the territories and even federally. There's certain disclosure requirements in some jurisdictions. There's sometimes director residency requirements. There's sometimes just structures like the ULC that are only available in certain jurisdictions. And so you really need to know kind of which best fits your needs. So for example, if a corporation is going to be owned by non-residents, Alberta or British Columbia are very popular because they have no director residency requirements. And they also have the ability for a corporation to become a ULC. So for example, if it's owned by US persons, that could be a significant advantage. Nova Scotia also has these benefits, but the Maritimes are not as popular as say BC and Alberta, just because their corporate registrars are typically slower and more paper-based. And so it can be more difficult to do things on short timeframes. So how is a corporation structured in terms of ownership and governance? So the interests in a corporation are owned by its shareholders. And they would hold, shares of various classes in the corporation. And in terms of how the share class capital is structured, overall, the authorized share capital must include voting rights, rights to the assets on liquidation, and rights to dividends. But this doesn't mean that those rights have to be attached to a single class of shares. For example, you could have 3 classes of shares, each one of which has one of those rights. And distributions from the corporation to its shareholders would typically be done in one of 3 ways. So you'd have dividends, which would be taxable unless they're capital dividends. You'd have returns of capital, which would basically be repaying what has been contributed to the corporation. And these are typically not taxable, but they can be in certain circumstances. And then you have shareholder appropriations, which might be shareholder benefits, but can also include things like embezzlement and things like that. And those would also be taxable. In terms of governance, decisions with respect to the corporation are made by the directors, with the exception of certain significant decisions which may require shareholder approval. For example, the sale of all or substantially all of the corporation's assets, or amalgamations or continuances into a different jurisdiction. But that doesn't necessarily mean that's all that requires shareholder approval. The shareholders can enter into a unanimous shareholder agreement or shareholder agreement, which can transfer decision-making power to the shareholders from the directors, or require higher thresholds for decisions than under the incorporating statute. So there is some flexibility there if you want more than the bare minimum provided by the statute. Patty will speak on this in more detail, but just briefly from a tax perspective, corporations are taxed on their own separately from their shareholders, and their income is computed at the corporate level. Corporations are desirable because corporate tax rates for active business income, which would include real estate development, are less than the top marginal rate for individuals. However, there can be a disadvantage for Canadian controlled corporations with respect to investment income, which may include rental income. And that may exceed the top marginal rate for an individual earning that income. One drawback to a corporate development corporation from a tax perspective is that if the development property is not already held in the corporation seeking to develop it, it can't be transferred into the corporation on a tax deferred basis. Only real property that is capital property and not inventory can be rolled in. So this would allow rental properties to be transferred into a corporation on a tax deferred basis, but not inventory held for development. So with that, I'm going to pass it off to Patty to talk more about the tax consequences related to corporations.
Hey everybody, thanks Jessica, thanks Cathy for the wonderful introduction. And I actually do want to say, Jane, kudos on the land acknowledgement. I mean, absolutely fantastic. I'm so proud of CREW of making that such a special language and special words. So Jessica, hard act to follow. You absolutely know your stuff. So I'll just add a little bit. We all know devil's in the details of tax. So very high level view, as Jessica mentioned, corporations are separate taxable entities from Revenue Canada's purposes. So they are separate from the shareholders of the corporation. And that way we see these corporations do have separate tax filings as well, and having to be done. Because they're separate taxpayers, profit is calculated in the corporation, as well as losses are calculated in the corporation, right? And they aren't available to necessarily to the partners and shareholders. Profits are available because the corporations, as Jessica mentioned, can pay dividends out, but losses are locked into that structure. When we talk about corporations, one of the things that is really important in understanding and for the tax is we always consider two levels of tax. There's tax at the corporate level, Jessica mentioned, and I'll talk about a little bit, but that's, you know, there and the profits are in the company and the cash is in the company. Then there's a second level of tax, which comes when the shareholders desire to obtain some of the income and cash flows out of the corporation. So when we're looking at tax benefits or disadvantages in any structure, we're always looking at the bottom. How much cash is in the jeans of the owner, or maybe these days, you know, how much crypto is in the wallet. But we want to make sure that we're getting down to comparing apples and oranges in the different structures. So just to bear with me a little bit about some of the specialties around tax in corporations and rental income, specifically in corporations. That in a corporation, we want the revenue income to be able to meet a test that's called the active business test, right? And if you don't meet this active business test, there is a very big cost, tax cost to earning the income in a corporation. Now, there might be legal reasons to have that corporate structure, right, that may offset some of the tax reasons to not have that structure if it's not active business income. So what is active business income? What does it look like? Well, it essentially means that the corporation's level of activity is quite substantive. The corporation must meet a test that there is the equivalent of more than 5 full-time employees active in the rental operations, right? So, you know, so that's a bit of a test, right? That could be, you know, having, you know, an active owner, maybe having an active CFO like Kara in the day-to-day. You may have a in-house leasing agent like maybe Twyla in there. You might have some maintenance folks, maybe there's a payroll person, HR person. So we really need to have some substantive activity for renting and earning rental income in order to meet this active business test. Okay, and why is this important? Well, the importance is the rate. So if you meet that active business test, the earning income in the corporation is very favorable. And the highest rate then you would pay in the corporation would be 23%. It could actually go down as low as 11%, right? How great is 23%? Pretty great. It's pretty great. If you didn't have the corporate structure, right, and you were earning this rental income, right, maybe on top of the T4 slip that you might have already, you could be paying as high as 48%, right? So that gives 25 cents of every dollar that you're earning of the rental profits to be able to use in the corporation to expand your business, maybe to do some additional TIs, repairs and maintenance work, etc. And you know, that's pretty great that you can do that, right? What's the catch or the hook though, right? You know, it sounds like rainbows and unicorns, having less tax and less tax rates. You know, why wouldn't everybody be doing this, right? Well, remember, there's a second level of tax with the corporations. The corporation calculates the taxable income, the corporation pays tax, then there's after-tax profits that are available to the owners. So when the owners pull that money out to use for their own personal needs, they pay a level of tax at that level. And in Alberta, we'd essentially say it's about 26%. So when we're looking at earning income through a corporation, we always look at what does it cost at the bottom. And so it would cost the 23% plus, you know, the extra to about a 49% rate compared to 48% earning personally, right? So from our perspective, from a tax perspective then, when are the corporations preferred? Well, number one, they are really preferred when the real estate operations has a substantial enough size to meet that active business test. If you don't meet that test, punt out, you know, from a tax point of view. You can also see that the corporations are preferred when the rental profits are going to exceed the needs of the owners, because that way we can leave the money in the company and we can have that extra 25 cents to be able to reinvest and grow. So that would be a time when we want to use a corporation. A disadvantage to corporations is the fact about losses. So if you are at a stage in the development where you may have taxable losses, you know, that are being generated, because the corporation is separate, those tax losses are not available to come out to the shareholders. So you couldn't grab those losses to offset your, you know, your employment income or maybe some pension income or other income that you would have personally. The losses aren't lost, they're available in the corporation against its future profits, but you know, it stays at that corporate level. So Kara, I'm going to turn it over to you so that you can tell our audience about some of the operational considerations for a corporation.
Thank you, Patty. Yes, so because we have typically been in a situation where we've both been developing projects as well as leasing out revenue producing property, we typically have not used corporations. We do have one or two, but we don't typically use them because properties can be under development for years. And so you can have losses sitting in that property, just doing nothing for who knows how long. We've had some that have taken 5 to 10 years to complete. So it has just never made sense from our point of view to have losses sitting in a corporation that we aren't able to offset against our revenue producing properties, because at the same time as developing, we typically hold fully or partially leased revenue producing income or revenue producing properties. But of course, that being said, from an operational and accounting and strictly asset management perspective, corporations are my favorite because they are the easiest to administer and they have a lot of advantages. From my perspective, they're just very simple. They have one single owner. So the legal entity is clearly defined. It's easy to explain. explain. It's easy to explain to people, who do you invoice? It's easy to explain who they need to pay, who holds the bank, the mortgage. It's just very simple. It eliminates that confusion that can come with some of the other structures. So the books are very clean, they're very simple and straightforward, since all of the assets, liabilities, revenue, and expenses belong to the corporation and reported only by the corporation. And then that single ownership, the biggest, well, one of the biggest benefits is it just really simplifies that GST registration, CRA registration. You have one GST number that you have to worry about. You have one business number you have to worry about, and it's dedicated specifically to that corporation. So it's very easy to track. It's easy to provide to people. And on their end, it's very easy to conduct business searches on those numbers. But then, of course, there are some disadvantages, and not just the disadvantages from tax perspective for our situation always have outweighed any of the benefits. But just from an administrative perspective, some of the disadvantages with a corporation are that they're less flexible. They're less flexible than more of a co-ownership structure. Even though we don't file the tax returns ourselves, we would provide backup to someone like Patty Walsh, just an expert to prepare and file our tax returns. But that being said, we have to make sure throughout the year that we're very conscious of the tax reporting requirements for the corporation, so that we can make sure to provide her with all of the relevant information that she's going to need. And then as well, when she's going to need it. We also have to be very mindful that there are, an array of deadlines that come with corporations and corporate reporting. So we have to make sure that we're able to compile everything and get it off to her in more than enough time to meet some of those deadlines and just, meet those tax consequences. So primarily, we do use other more co-ownership structures. And so I will pass it back to Jessica to talk about some of those.
Thanks very much, Kara. So the second structure I'm going to discuss, and one of the most popular, is the partnership. So partnerships aren't separate legal entities, but are formed when there are two or more persons who are carrying on business in common with a view to a profit. And that doesn't mean you actually have to earn a profit. You can certainly have a partnership where the business is unsuccessful, but you need to go into the partnership with the intent to earn a profit. And partnerships are governed by the relevant provincial or territorial partnership law. And so this is all set out right at the beginning of the Partnership Act that applies in terms of when you do and don't have a partnership. But similar to corporations, there's no need to form the partnership in the jurisdiction you're operating in. However, you will almost certainly need to extra provincially register, and this is the same with corporations, in all jurisdictions in which the partnership owns real property or carries on business. So the Partnership Acts in various provinces, there's some distinctions, but I don't think there's as many as you would see between Business Corporations Acts, at least as far as it goes with general partners. When you get into limited partnerships and LLPs, which I'll talk about in a minute, there may be more differences, and so that might impact your choice of jurisdiction. So partnerships are an extremely flexible vehicle for real estate projects, because while they need to comply with the Partnership Act and federal and provincial tax legislation, the partnership agreement offers quite a bit of opportunity for unique arrangement based on the particular circumstances of the partners. The partnership agreement will typically set out how interactions between the partners will be governed, how the business of the partnership will be run, how income and losses, both for partnership and tax purposes, will be allocated, how profits will be distributed, and when and how the partnership will be dissolved and its remaining assets, if any, will be distributed. And you can have a partnership go for any length of time. It can operate indefinitely until wound up by the partners or operation of law, or you can have it for a fixed time. And so you say, we want to do this business for 5 years. The partnership will wind up, in 5 years, or if we dissolve it sooner. So it's a very flexible vehicle. It's in terms of dissolution, it's actually very important to ensure that your partnership agreement does deal with dissolution, because if your agreement is silent, then the partnership will be dissolved on the death of a partner, the bankruptcy of a partner, or the assignment of a partner's property for the benefit of its creditors. So if you have a partnership that has, more than two people, you're going to want to address that and ensure that any of those instances, particularly if you have individuals as partners, are not going to result in the dissolution of the partnership. So there are three types of partnerships: general partnership, limited partnership, and an LLP. And unless certain filings are made with the applicable corporate registrar, a partnership will be a general partnership. Partnerships, a partnership will be dissolved. As I mentioned before, a partnership is when two or more people carry on business in common. So a partnership will be dissolved by operation of law if there are ever fewer than two partners. You cannot have a partnership of one. You're just a sole proprietor at that point. So if a partnership is a general partnership, each of the partners has the ability to bind the other partners, and each partner is jointly and severally liable for all of the liabilities of the partnership during the period in which they are a partner. This makes the general partnership structure undesirable for projects that carry significant risk, such as development projects and even rentals, because the partners may not wish to have unlimited liability for the liabilities of the partnership. So due to these risks, as I said, I typically don't see general partnerships for real estate development or large scale rentals. They're more commonly seen for farms or occasionally professional partnerships where you have, like a group of doctors or other regulated professionals who aren't actually permitted to limit their liability, at least for their professional services. So you may see general partners more in that sphere. So this leads us into limited partnerships, which are more frequently desirable for real estate projects, specifically during the development stage, because that is where there's a significant degree of risk. So under the limited partnership structure, there's a general partner who has unlimited liability for the liabilities of the partnership and is responsible for the management of the partnership business. Typically, a general partner will be formed for the project. It'll usually have a nominal amount of assets, a nominal amount of capital contributions. And so the fact that it has unlimited liability isn't significant because it doesn't have significant assets to lose. The liability of the limited partners, however, is limited to the capital contributed to the venture. So if you had a limited partner investing $5 million in the venture, they've paid that contribution, they're not going to be on the hook for anything more, provided they don't take actions in the partnership to lose their limited liability. And so that would be taking part in the control or management of the partnership business. With respect to the general partnership or general partner part of the limited partnership, it will typically have a limited interest in the partnership, like 0.01%, and it will make a very limited contribution because it itself will typically be nominally capitalized. Depending on the structure, it will frequently be owned by one or more of the limited partners or persons or entities related to them. But the majority of the income and the value of the project will typically belong to the limited partners. It doesn't have to. I've seen, limited partners where the LPs and the GP, the GP had a 50% interest in the partnership and the LPs had 50%, but that would be rare. Typically you see, the limited partners having a 99+ percentage interest in the partnership. In Alberta, a partnership will become a limited partnership when a certificate is filed with the Alberta Corporate Registrar. So you can call yourself a limited partnership before that time, but you won't have that limited liability protection until that certificate is filed. So it's very important to ensure that that is filed on a timely basis. There is a third type of partnership, the LLP, but in Alberta, it's limited to certain regulated professionals. So those who are permitted to have professional corporations. It's not limited in BC. So you might, if you do any interprovincial work, you might see BC LLPs, but they are still relatively rare. In terms of ownership of property, any property owned by the partnership belongs to the partnership, and the partners do not have a direct ownership of the property. They merely have an interest in the partnership. However, a partner is not a legal person, is not a person, and so legal title to land can't be held in the name of the partnership itself. So, for example, in a limited partnership, land would typically be held in the name of the general partner or a nominee corporation who would hold legal title but has no beneficial interest in the property on behalf of the partnership itself. In a general partnership, if you ever had one, the nominee would frequently be used because otherwise you typically need all of the partners to have their names on title. As one of my partners said, if anyone says they want to use a general partnership to hold land, just tell them no or use a nominee corporation. Partnerships are particularly useful from a tax perspective, particularly with respect to real estate development. So as I mentioned with corporations, you can't transfer development property into a corporation on a tax deferred basis. You can, however, do that into a partnership. So you can, if say a corporation held a valuable piece of real estate inventory, it could transfer that piece of inventory, real estate inventory, into a partnership on a tax deferred basis. So with that, I'm going to pass it back to Patty. Thank you very much.
Thanks, Jessica. And before I go and talk more about partnerships, Team CREW, I really just want to let you know, just working with Jessica and Kara through this, these ladies are top notch in knowing their stuff. So if you get anything out of here, I think it is that we've got the top people in town who can handle anything with respect to structuring real estate. So I'll talk a little bit about partnerships. And as they're, a little bit more complex, as you can hear from listening to Jessica, from setting up, they're a little bit more complex from a tax point of view as well. So the partnership is not a taxable entity for Revenue Canada purposes. The partnership itself does not pay tax. And this is for any kind of partnership, whether it's a general partnership or a limited partnership, it is not a taxable entity. However, like a corporation, the partnership must calculate its taxable income at the group level, at the partnership level. So the revenues, expenses, deductions are calculated at that level, and then the profits are distributed out or allocated to the partners, and they are responsible for paying the taxes on any profits, right? There are, though, mandatory tax filings required for partnerships, and essentially they're information returns that basically tell Revenue Canada, right, what are the profits of the partnership, who are the partners of that partnership, and how much income is being allocated to them. So very much like, your T4 slips, Revenue Canada does get information, where they can come back and ensure that the individual partners are picking up the partner income appropriately. Like corporations as well, that 5 full-time employee test is also very, very important in partnerships, because when partnerships earn income, the type of income that the partner picks up is related to the type of income that the partnership allocates. So, we're looking again like at active business income is very, very important. Very big distinction on partnerships, though, is unlike corporations, partnerships can allocate their losses out to the partners. And losses, generally are tax pay, is cash. If you've got a loss because you've got wages, in excess of your rental incomes, that's cash that you put out. So the ability to use losses is important because you do get some cash back. You get some cash coverage of your other taxes. So one of the key advantages of the partnership we see is that it allows multiple people that have different objectives to come together for a project. And very, very simple example of sort of the difference of this would be, if I've got a corporation, Robin and, Karen, you guys have a corporation together for a project, right? Robin comes and says, oh man, this freeze and thaw has wrecked the roof of my cabin. you know what, I need to take $25,000 out of the company, right, or corporation, right, to help with, pay the bill for my cabin roof, right? Karen comes out and says, I don't want to take any money out of the corporation. We don't need to take any money out of the corporation. I want to leave it in there and grow our portfolio. So you can have a disconnect at the owner level, at the shareholder level with a corporation. And how are you going to deal with that? With the partnership, right? You as a partner, allocate the profits, you do some cash management. So you can do what you need with respect to the cash flows that's coming in, able to come out of that partnership. One important thing to remember, though, that again, because there's no tax calculated at the partnership level, partners have to be very, very aware in their budgeting to allow for taxes to come. If you're getting a check from your partnership of $10,000, that check is not coming to you tax paid. So you need to put, squirrel a little bit away to be able to pay those taxes if you need to. So I want to just speak a little bit about limited partnerships because they are a structure that is seen, and whether it's in real estate or in other ventures, that limited liability is something that people really do desire in terms of protecting their families and their estate and their wealth. So the tax rules mirror quite closely that concept of limitation. So as Jessica had said, if you were a limited partner, right, you have limited liability, with respect to the overall, operations of the partnership. And tax rules say, you know what, if you are a limited partner and you have limited exposure, right, to disadvantages of the partnership, we're actually going to limit for you the deductions that you're able to take, in trade-off for taking that limited liability. And therefore, when losses come out of a partnership, limited partners are restricted in how much of those losses that they can take to offset their other, forms of income. And what they're limited to take is actually limited to their investment in that partnership. So if you had a partnership with $1 million of losses and they're allocating out, let's say, $100,000 to each partner, if I had put in, $100,000 last year into that partnership, and the partnership had sent me back $50,000 cash. We refinanced with, RBC, and we up, and there was some extra equity, and the partnership shipped out $50,000 to me. Well, now I have a net investment of $50,000 in that partnership. And even though they're going to give me $100,000 of losses allocated to me, I can only make utilization this year of 50 because that's all I have invested in the partnership. So really, really important that we understand both the budgeting for taxes later, because they're not paid before the cash gets to you, and the concept of losses and how much you're going to be able to get depending upon what your actual net investment exposure is. So overall, from a tax point of view, when are they beneficial? Well, number one, of course, is there an advantage when your project is generating losses. Like Kara had mentioned before, some of these developments have a long tail on them, and you have many, many years. And if there are tax deductions that are available to generate losses, you would want that to be in a partnership, so you can recoup at the time you're making those investments. Also, we can see if you have partners, with different economic states, right? They don't have to negotiate to figure out, what's going to come to them like you do in a corporation. It's yours. You can do with it what you want. Just make sure you're paying your own taxes. I think the other thing, and we're not going to touch on at this moment, but partnerships, I think, as Jessica mentioned, there's all kinds of nuances about them in the partnership agreements and constituting them, etc. For tax purposes, there's all kinds of details. There's very significant details about what deductions are allowable depending upon the composition of the partners and the business. So just if you're getting into that structure, obviously you can tell you're going to need, some legal advice. Make sure you set it up properly, but also from the tax point of view, make sure that you're getting the advice so that all the expectations, there's no expectation gap in what you think is going to happen and what's going to happen for you. Kara, I guess if you can let our ladies know what might be some of the operational considerations you do with partnerships, that would be good.
Thank you. And yeah, so funny enough, we don't tend to use LPs as often. We have a couple of them, but primarily we use joint ventures, which we'll be talking about in the next round. So I won't speak too much about the operations for limited partnerships. But as far as the reporting that we do on them, they actually do share some advantages with both corporations and joint ventures, and disadvantages as well. So, but some of the advantages, again, the ownership is relatively clear and simple, having that general partner acting on behalf of the partnership, but that can also create some confusion now that you're getting into this general partner that doesn't really own anything. So this is where your billing entities and your GST can become more complicated, because you don't want to be filing under the wrong entity, and you really have to watch out in this instance for your invoicing, because you want to avoid getting into the habit of your invoicing going to the wrong entity, or your payments going to the wrong entity, or it can create problems with CRA disallowing GST claims, and it can just create a huge headache. But some of the other advantages, of course, with an LP itself, it's nice that you don't have to be reporting any tax implications or consequences. So you don't have to report amortization in the LP. You don't have to worry about your contingency for taxes payable. All of that will end up deferring to the ownership levels. So just from a bookkeeping perspective, they're really simple to manage and to administer. But I believe, that's probably the primary reason that we don't use them as often, because they do have that inflexibility as far as, having some of those loss restrictions. So although our owners can apply partnership losses to some of their other income and their other projects, it just doesn't have the same flexibility that the joint ventures have. So again, yeah, if you've got exactly what Patty said, and if we're top notch, Patty, you're like stratospheric notch. I don't even know what to say about you. Ladies are amazing. But if you do have multiple owners in various tax positions, it just might not be the most advantageous to all of them. And so that's why we almost exclusively use joint ventures. So Jessica, why don't you tell us about joint ventures?
Thank you, Kara. And yes, thank you, Patty. I want to echo Kara's words. Yes, if we're great, Patty's just up here. So thanks so much. So yes, joint ventures is the final structure I'm going to discuss today. So in general, a joint venture is a business relationship where two or more people combine their assets or expertise for typically a specific undertaking, often for a set duration. And if that sounds a lot like a partnership, that's because there's a very fine line between a joint venture and a partnership. So there's, the following features of a joint venture can make them very attractive for many business relationships, which is, they can share risk in terms of expenses and also just in terms of capital outlays. So in a joint venture, typically you pool assets together, but would maintain ownership of them. And so in terms of if you have a development project, you'd have less to expend because someone else, while participating in a share of revenue and expenses, wouldn't necessarily be your partner, but would be contributing capital to kind of this project you're working on together. So you can share risks, expenses, revenues, and capital. One benefit over a partnership is that joint venturers are only liable for their own actions. So in a partnership, in a limited partnership, the general partner has the ability to bind the partnership. In a general partnership, any one of the partners can bind the partnership. And because you have unlimited liability there, you can be responsible for any of the actions taken by your other partners in carrying out the partnership business without knowing about it or consenting to it. That can't happen in a joint venture. The joint venturers are only liable for their own actions. unless you explicitly consent to one of the venturers acting as your agent. And this does sometimes happen. You might have a managing venturer and you would give them consent to undertake specific activities, but it would be on a consent basis and it wouldn't be a general ability to find the venturers. Each venturer continues to own their own specific property, and so separate tax accounts are maintained. And Patty's going to talk a little bit more about this, but this is particularly beneficial as each joint venturer can maximize their own discretionary deductions, for example, capital cost allowance. Now, when do you have a joint venture and when do you have a partnership? So the existence of a joint venture is a question of fact. Here are some common components of a joint venture. So usually you have it lasting for a specific project or for a specific duration. You see it most commonly in real estate development, sometimes in leasing and mining. Those would be the most common places you'd see a joint venture. Anything where you have large scale capital being involved is typically where you'd see a joint venture. So the venturers would contribute assets by making the assets available to the business or operation, but would still continue to own them. There would be, so as I mentioned with a partnership, each partner has an interest in the partnership, but does not continue to own the assets. In a joint venture, the venture would continue to own it. It would have a direct ownership interest in the property being used in the joint venture. It would be a contribution in terms of determining maybe their share of revenues and their share of expenses, but it would not belong to the venture because the joint venture is really just a contractual relationship. Typically in real estate, if there are assets being acquired as part of the project, we'll see title held by a nominee corporation or a managing venturer. And then each venturer would have a direct, undivided beneficial interest in the real estate. So what are the distinctions between a partnership and a joint venture? Because that line is very thin. So a joint venture would typically involve the sharing of gross revenues and expenses and the sharing of property in terms of use. And you wouldn't have the same calculation of profit that you would see at the partnership level. There would be a line by line of this is the revenue, these are the expenses, this is your share of the revenue, this is your share of the expenses, and then you would go off as a venturer and calculate your own income. So this is quite important from an accounting perspective. And it's very important that, typically you would have a joint venture set of books and records. Kara will talk about this a little more, but you would have very detailed descriptions that you're providing to the venture in terms of what it is. It's not just at the end of the day, here's your net profit from the venture, which is instead what you would receive if you were a partner in a partnership. However, because that line is so thin between a partnership and a joint venture, and you don't want the potential negative tax consequences from having a partnership, every joint venture agreement I've ever seen has an express negation of the partnership relationship. So there will be a paragraph that says, this is a joint venture, this is not a partnership. No party to this agreement has the ability to bind the others except as expressly stated in this agreement, et cetera, et cetera. And this is critical. I would never sign a joint venture agreement without that paragraph because there's a significant risk that CRA reassesses and says, no, we think you're a partnership. Whereas corporations and partnerships are governed by specific legislation, joint ventures don't have any specific legislation, so they would be governed by contract law. Typically, the joint venture agreement would be governed by the law in which the project is taking place, especially in real estate. You wouldn't typically pick another jurisdiction because real estate is a movable property, and typically the law where the property is located is what's applied. So if you have a project in Alberta, your joint venture would typically be governed by Alberta contract law. And then the last thing would be that there's the different tax treatment that exists for the two relationships. So as I already mentioned, partnership tells you what the partnership's profit is, and you just include that in your income. The joint venture would just set out all the kind of the gross revenue, gross expenses, and then you would calculate your profit at the end of the day. So with that, I'll pass it to Patty to talk about the tax consequences of joint ventures.
Thank you. I do see a lot of times that there's a sort of interplay with the language about, joint venture, and, people are, got a joint venture with my sister-in-law, etc. So when I'm talking about tax planning and ensuring that it's not a partnership, I talk about it as being a co-ownership, right? So just interchange joint venture with co-ownership, because I think then it really clearly talks about then what the expectations are. So likewise with the corporate world, the joint ventures or co-ownerships are not regarded as a separate taxpayer at all. They are not recognized separately for tax. They're really a proportionate sharing model. So each co-owner reports their own proportionate share of their revenues and expenses, and they are also then able to do their own tax planning with respect to if there are any income or deduction planning advantages or disadvantages. They can sometimes choose those themselves. The other that Carol will get into later as well is because this is co-ownerships and there isn't sort of a calculating of sort of the net of this, each co-owner has to pick up their income and expenses based on their regular operating cycles, right? So picking up line by line, let's say you're a third, it's 1/3 of your parking revenues, it's 1/3 of your CAM revenues, it's 1/3 of the tenant inducements that are made come directly to the 1/3 partner to add in and combine with anything else that they might have is co-owner in that joint venture. So from a tax perspective, I guess when there's the co-ownership joint venture advantageous, it's very advantageous, of course, same idea when you have two venturers with different needs for cash and tax planning, because what one venturer is doing is not tainting the actions of the other. And we see the joint venture working significantly well. For example, when you've got private equity coming in, or you may have pension plans coming in, because of the nature of their inaction in a single project, right? They're typically getting reports, but they're not on the ground every day directing it. So they're not active in something. They would be considered to not be earning active income. And we wouldn't want that nature of their activity to potentially taint, Camgill and Kara, who might be picking it up, is because they are active in the joint venture and they can now get that active business income with the higher rates. So I think the hurdle really for the joint ventures and the co-ownership is really not at the tax level. It's really pretty plain vanilla there. I think the hurdle in this structure is actually the legal setup of it, the financing of it, right? Because you have undivided interest in things, and the operational elements that come, to achieve the joint venture structure. And Kara, over to you, as you live and breathe this daily.
Oh boy, I sure do. Yes, they do work exceptionally well for multiple owners with different investments and different tax requirements, which is exactly what we have. So they have worked. The accounting itself in theory is very straightforward. You pick up your expenses, you pick up your income. You pick up any changes to your assets and liabilities. So no dealing with income tax contingencies, no dealing with amortization. And so the compilation, right, the actual look of the statements, it is fairly simple. But where the complexities come in is, in my opinion, one of the greatest drawbacks using joint ventures is that it doesn't have an owner. It isn't a thing, right? So it can become extremely complicated to start explaining to vendors and to tenants and even to your own employees who do you invoice, who owns this property, who does the tenant pay, who is the bank account under. It can get so complicated. It's just like the general partner of an LP. It doesn't own anything, so it can't be filing its own GST. It can't be claiming refunds. This is where your JV agreement and then having all of the clear delegations becomes absolutely essential, and having that, authorization for a single owner to be acting on behalf of the joint venture, and then using those non-B corporations to hold all of your investments. And then the other aspect of a joint venture that can become extremely daunting is the multi-period reporting. So if I have 5 owners of a joint venture with 5 different year ends, in conjunction with my actual joint venture, because a joint venture will have a year end, so I'll be filing those statements, and then I'll have to prepare essentially an entire complete set of, as accurate as possible, financial statements to distribute to every single other owner of the joint venture. And when you're looking at one joint venture, that's not such a big deal. But when you're looking at 50 or 60, you can feel sometimes that all you're doing throughout the year is producing financial statements. And so, typically to make it as painless as possible, it's very important to have that clear JV agreement in place. It's very important to understand your responsibilities in relation to the other owners, and to really just develop a good relationship with those other owners so that you know what they need and you know when they're going to need it. And it should keep you in smooth sailing as much as possible. So I'm going to hand it back to Cathy to wrap us up, and to Jane to give out some door prizes.
Well, thank you all very much for a fantastic discussion about the differences and pros and cons of using corporations, partnerships, and joint ventures in a real estate context. I've been involved in real estate for a long time, and I found this really informative, lots of new information, and really well presented. So thank you all. We think we have time for some questions. I don't know, Jane, we're right on the 1 o'clock, but can we go ahead with a couple of questions if people have any?
Yeah, if there's a couple of questions, I think it's fine to go ahead.
Okay, so if you want to type any questions in the chat, there aren't any there right now. I'm going to start off just with one question, just in case it helps to get it rolling. So Jessica and Patty, for legal and accounting setup, is there a material difference in cost for using these different structures that you talked about today?
Yes, Cathy. So from a cost perspective, the cheapest is typically the corporation. Although if you're getting into, detailed unanimous shareholders agreements, then that gets you, considerably, significantly more expensive. If you've got really, detailed share structures, if you're trying to use tracking shares, then obviously that increases the cost, and you're looking more at a partnership cost. Partnership and joint ventures typically have similar costs. They both need to set out the structure very clearly, everybody's responsibilities, profit sharing, and so those would typically be closer together in terms of costs. But the corporation, if it's relatively simple, would by far be the cheapest, and the partnership and the joint venture more expensive. Patty, from the accounting side? Oh, you're on mute.
There we go. Point and click as a challenge. Yeah, I think you nailed it. I think as you go with the complexity for, the legal side, I mean, that translates into, the individual owners and entities, et cetera. So from a tax point of view, the complexity, mirrors as well.
Thank you.
Cathy, you're on mute.
Sorry. Okay. Thank you both for that. Jessica, if you're using an LP structure, like a limited partnership, you mentioned that limited partners have limited liability as long as they aren't active in the management of the limited partnership. So how do you typically work around that when you have people who want to both run the general partner and also participate as limited partners in the limited partnership?
So typically in this case, we would have, individuals acting as directors of the general partner, and they would be carrying out the activities, in their capacity as directors or officers of the general partner, and that's how they would be involved in the business. And then they would typically hold their limited partnership interest corporately or through a non-personal vehicle. And where you get into confusion is where you have typically less sophisticated investors who are holding their limited partnership interest personally, and then are also directors of the general partnership and are signing things with their name, writing partner. And so we certainly had to either recommend that a client, if they can't keep it straight for liability purposes, moving their LP into a corporation, so it's clear that that person is not a partner, and also making sure that they stop signing things as partner. But it can be very difficult, and so you want to make sure that distinction is clearly explained, and that everything that is being signed is shown that they're signing in their capacity as a general partner. They're holding themselves out as a director or officer of the general partner, and they're not holding themselves out as a partner themselves.
That's great. Thank you. One last question. In your opinion, who should be the borrower when a limited partnership owns real estate? Should it be the limited partnership? As it in its own right, or should it be the general partner for and on behalf of the limited partnership? And does it matter?
I don't think it typically matters, just because the partnership is not a legal entity. Usually you would see the document structured as the partnership by the general partner in terms of signing. But you certainly want to make it clear that it is the partnership itself borrowing, because that is where the assets are going to be held, and the general partner will typically have nothing. So if they're just signing themselves, and it's not clear that they're doing the borrowing on behalf of the partnership, that can cause trouble from a banking perspective. It doesn't really matter from a liability perspective, because the general partner is wholly liable for any debts of the limited partnership anyway. But just for clarity, it's best to have the limited partnership by the general partner be the borrower.
Great, thank you. I don't see any more questions in the chat, so I'm going to turn it back over to Jane, and thank you all again for a wonderful presentation.
Yeah, that was great. So I guess with that, we will close out our panel discussion today. A huge thank you to Cathy Farnell, Kara Engley, Jessica Fabro, and Patty Walsh for an informative and engaging discussion. We truly appreciate your time and expertise. If there's any further questions for our speakers today, please reach out to them directly via email.
Sorry, Jane, just one thing. The ending of my email is .com, not .ca.
Perfect. Okay, we'll send out this slideshow with that edit with the recording as well. Then thanks.
Perfect. Thank you.
As a token of appreciation to the panel, a donation has been made to the CREW Foundation in your honor. Edmonton CREW would once again like to extend a big thank you to this event's featured sponsors, our diamond sponsor, One Properties, our platinum sponsors, Cushman & Wakefield, GWL Realty Advisors, Institutional Property Advisors, Manulife Investment Management, RBC, TD Bank Group, the RMS Group, and Witten LLP. Thank you. Without the support of these companies, Edmonton CREW could not bring this programming to you. An email will be sent out in the next couple of days with a short survey for you to provide feedback on today's event. This helps Edmonton CREW in planning future education events and improving our programming. And now for our door prize, the recipient of a $50 gift certificate to Red Ribbon Boutique and a few pieces of cool Edmonton CREW swag is Ashley Reagan from MLT Aikens. Ashley, you'll receive an email in the next couple of days from our third-party manager, ManageWise. Thank you everyone so much today for your time. We hope you'll join Edmonton CREW for more events in the coming weeks, and we look forward to seeing all of you in person again sometime soon. Enjoy the rest of your day, everyone. Thank you, ladies.
Thank you. Thank
much.
you, Cathy. Thank you, Jane.
Thank you.